This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Stocks routed, the Dow dives, tech stocks tank as the blue chip index sheds more than 500 points to cap the worst week on Wall Street in 4 years.
Oil breaks 40. Crude prices continue to crater, falling briefly below that key level. And there's one big problem for that commodity that isn't going away anytime soon.
And needed repairs. Bridges are crumbling, but one state found a fast fix. They become one of its biggest problems. The final part of our week-long series, The Big Fix, tonight on Nightly Business Report for Friday, August 21st.
Good evening, everyone, and welcome. The correction that many have been calling for is here. The Dow Jones Industrial Average, plummeting more than 500 points today, is now down more than 10% from its recent high. And it's not alone. The tech-heavy NASDAQ and the small-cap Russell 2000 index have also fallen that same amount. The reasons for the selling, which we've been seeing all week, boil down to three things: China, the Federal Reserve, and oil. But today, the losses intensified. By the close, the blue chip Dow index tumbled 530 points to 16,459 on very heavy volume. The NASDAQ shed 171 points, or 3.5%, and the S&P 500 lost 64. For the week, all three major indices were off more than 5%, with the NASDAQ losing the most. According to S&P, issues within the S&P 500 index lost more than $1 trillion in market value this week. And as stocks fell, so did bond yields, the 10-year now hovering just above 2%. Bob Pisani takes a look at the mood on the street and what investors may be in for next week.
What a day and what a week. The S&P 500 is down more than 5%. This is the worst week since September 2011. There was no immediate catalyst for the decline, and that's why traders were taken by surprise by the heavy selling. It was a vague mix of concerns on slowing global growth, concerns that had been building for months, frankly. China started dropping in June. Brazil started dropping at the end of last year. So where's the market bottom? I have no idea, but the fear level is pretty high, higher than it's been all year, and that's a good sign. The VIX, or fear indicator, has gone through the roof this week, practically doubling, indicating that traders are willing to pay for protection that they didn't have before. And traders were very busy buying and selling stocks and options. One trader told me it was the busiest day he's had in 18 months. Okay, what about next week? Housing's one of the few bright spots. We get new home sales on Tuesday, we get durable goods on Wednesday, but the big event will be the Jackson Hole Conference for the Kansas City Fed's annual gathering of central bank officials from around the world. That starts on Thursday. Still, the economic data and the meeting will take a backseat to market sentiment. What will happen there? Well, look at it this way. The contribution of China to the S&P 500's revenues are only in the mid-single digits, and that's not much. And we have already priced in a huge slowdown in China. Cyclical global stocks, for example, like General Electric, are all down like 15% or more. Commodity stocks are in a bear market. Most of them are down 20, 30, even 40%. With this level of fear, many feel we are setting up for a short-term bounce. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
So how concerned are you, the individual investor, about the sell-off in the market? We sent our cameras to find out.
Makes me nervous for the future. I don't invest in individual stocks, but I do have some funds, and they're going down.
Yes, it is concerning, but overall, I would not necessarily say that it's going to affect my life right now. It would be more concerning about my long term.
My retirement account is going down. I was watching it online, and I have investments. I'm watching that, so I'm real upset about that.
It's definitely hitting my 401k and my personal net worth. It is also a buying opportunity.
I didn't know about it, but I'm going to go check my 401k now.
On that note, let's talk to our next guest. He manages money for individual investors and has had a very busy week fielding questions from some nervous clients. He is Richard Capa, Managing Director at Wealth Health. Nice to have you here.
Thank you.
So what have your clients been asking you, and what have you been telling them?
Well, a lot have been asking about, the nervousness of the market. How long will this continue? How much further do you think it's going to go? And I think the one good thing that I could say is that people aren't as unnerved as you would imagine, because I think we've been talking to clients for years now about 10% correction. That's the buzzword, and it's been since 2011 since we've had a 10% correction. Typically, you have that once a year to twice a year. So we've been kind of having that conversation for a while. And so I think the time has come. And for people with cash, I think this is the time, as some of the people just said here, this is an opportunity to buy. We always think about selling when the markets are going down and doing the opposite of what we really should be doing.
This is, I don't mean to be Pollyanna here, but these kinds of days, these kinds of weeks are times where the phrase risk tolerance really becomes real.
Absolutely.
And what if I have now today bumped up against my risk tolerance and I go, I am not comfortable with my equity allocation? In what areas do I take money off the table?
Well, that's a common question. I mean, my job is to make sure from a stress test is that the portfolio can support your needs, your cash flow needs. However, I have to balance that with the emotional risk tolerance. And in this case, what you're saying is I can't take it anymore. Where I would be looking, which I have been looking at, is the large cap value, large cap growth area. That's the area over the last 5 years that have done the best. So I think taking some gains off there, maybe up to 5%, would satisfy the emotional risk tolerance of a client. Secondarily, I'd probably look at some of the emerging markets because I think that's a troublesome area going forward.
But not because they've done terribly well over the past few years.
No, not at all.
Right. You know, if this continues, though, I mean, is this correction a little bit different this time because it's mainly being triggered by China? Does that change the nature of this correction or not? Maybe it doesn't.
I think we always try to look for what is different this time when we're in it. And I think what we look at in reverse is that nothing's that different. We live through it. There's different reasons, different causes for these events, but the market continues over time if you're a long-term investor. I do think, however, to your point, that China is probably driving this correction because 2 or 3 weeks ago, we knew Greece was out of the mix, at least, temporarily. We also knew that the Fed was likely to raise rates, or the argument was September or maybe later this year. That hasn't changed. Maybe they'll push even further because of the events here. But I think the uncertainty in China is driving that. And the problem is we don't really know what the growth is really going to look like going forward. We're a little speculating at this time because of the devaluation of their currency.
Thank you so much for joining us, Richard.
You're welcome.
Appreciate it very much.
Have a good weekend.
You too.
Stay solvent. All right. Oil prices fell below $40 a barrel midday today, something that hasn't happened since 2009, the heart of the Great Recession. By the settle, crude prices were down 2% to $40.45, marking another week of losses. Longest such losing streak since 1986. John Kilduff is founding partner at Again Capital, and he joins us now, or rejoins us, as he often does on these wild days in the oil markets. John, what's going to happen?
Well, I think it's going to keep going, Tyler. As much as the stock investors are worried about China, this is a real gut check for the oil market. Because if the oil market loses the demand and loses the economic engine of China for the future here, it's really bad news for crude oil.
So, John, how much lower do you think prices could go? And now we're starting to hear that word deflation bandied about again.
Yeah, and I think the deflation comes from, Sue, the fact that the global commodity supply chain got built out across the board in a big way to satisfy China and her demand for these various base metals and oil. And it got overbuilt. So now we're seeing that the effect of that from China's decline economically. The price of crude oil, I believe, will ultimately bottom out later in the year, now in the mid-$20 range, $25 a barrel, before this is all said and done. There's just too much supply. There's too much worry about Asia. It's a terrific 1-2 punch for crude oil prices.
This is obviously a pain for people who work in the oil business, for Texas, for some of the producing areas in this country, Canada. But on balance, John, is lower priced oil a good thing for the economy?
It most certainly is. Look, 80% of the crude oil barrel in this country goes to transportation. So literally planes, trains, and automobiles. Obviously, that's going to improve the bottom lines of the transportation companies, of consumers, and it makes people feel good. It's a boost to consumer confidence when you see pump prices fall below $2 a gallon, and that's in the process of happening in many communities across the country. I think what's hurtful here is that the shale boom in this country that really got us to where we are right now was a leader in terms of job creation and other things. But, it's a boom and bust cycle. The folks that are involved with that are used to it, and they'll have their day again in the sun. It's just not going to be right now or for a while.
John, you know, this brings us kind of full circle to the Federal Reserve, because they've been looking for some inflation in the economy. And again, today, I was hearing a lot from analysts about we may be entering a deflationary cycle. Can they raise rates if we're in that deflationary cycle?
Well, it's interesting, Sue, because obviously they also focus on employment, and that is terrifically strong here in the U.S., no doubt about it. In terms of the inflation side of the equation, you know, the answer has to be no, although they do try to exclude food and energy in their analysis. But no, this is going to feed through and keep a lid on things. But they can't ignore what's being affected mostly in the situation here, and that's the China syndrome that we're going through. So I believe that's going to hold them back now.
All right, John, thank you very much for being with us. Have a great weekend.
You too.
As we've been saying, we are well aware of the pain that low crude oil prices are causing, especially in those oil-producing regions of the U.S. But for consumers of oil, it's a different story. So Morgan Brennan reports now on the important sectors of the economy that are actually benefiting.
With U.S. oil futures dipping below $40 a barrel, it's easy to spot the losers, from energy companies to jobs to the ripple effects on the broader stock market. But when oil falls this low, it also mints winners. The biggest being the consumer, whose savings at the pump has been translating into spending elsewhere.
Typically, the first thing you do is you go out to eat. That started to show itself up in restaurant same-store sales. We're continuing to see that in the second quarter and heading into the third quarter.
Consumers have also been plowing those savings into real estate, with home purchases on the rise and home improvement retailers like Home Depot and Lowe's reporting stronger sales. Automakers have benefited in a few ways as well. Last quarter, General Motors sold more trucks and SUVs amid cheap gas prices. That helped the company post earnings that were 4 times better than a year ago. And more Americans are taking road trips. Federal data shows Americans drove more miles in June than ever before, pushing gas use toward a new record. That helps tire manufacturers like Goodyear Tire and Bridgestone. Not only does driving drive up demand for new cars and parts, but cheap oil makes the cost of producing synthetic rubber less expensive.
When you step away from the consumer and consumer discretionary spending, the next place you want to look is enterprise. So anybody that's manufacturing anything that takes energy or needs to be delivered is a beneficiary.
Including transportation companies, which count fuel among their highest costs. Airlines like United Continental and Southwest have seen their jet fuel bills drop, bolstering earnings despite weakness in revenue. And cheaper diesel has made trucking more cost competitive over longer distances with railroads, a dynamic that's pulled some business from tracks to roads.
Hogan says between the increased spending power of consumers and the lower cost to move goods around the country, all of these oil tailwinds should have a, quote, huge benefit for 85% of the S&P 500. It's a key point to consider after a sea of red arrows on Wall Street this week. For a Nightly Business Report, I'm Morgan Brennan.
The president of the St. Louis Fed is a big advocate of raising interest rates at the central bank's September meeting, and he reiterated that stance today. In an interview, James Bullard said he was upbeat about the U.S. economic outlook, even as oil prices drop and concerns over China grow.
And U.S. Treasury Secretary Jack Lew told a top Chinese official in a phone call today that the United States will closely monitor China's new currency policy. The call comes after China recently pushed the value of its yuan sharply lower against the dollar, a move that makes exports more competitive with the U.S. Lew also urged China to continue with its economic reforms.
Still ahead, bargain stocks to buy in a market sell-off. Our market monitor has identified some names he says are worth owning right now.
Some of the most recognizable stocks are now in a bear market. 1/3 of the Dow now trading 20% or more below their 52-week highs. And they include Chevron, which is down nearly 40% since its most recent 52-week high, followed by DuPont, Caterpillar, Intel, Exxon, Walmart, United Technologies, IBM, P&G, and Apple.
Our market monitor is using the sell-off in some of those big-name companies to buy more shares at a lower price. He's Randall Ely, President and Chief Investment Officer at Edgar Lomax Company. Randall, welcome. Good to have you with us. Last time you were on, you joined us in January. You recommended AT&T, which is flat since then, ExxonMobil, which is off more than 20%, and Johnson & Johnson, which is down 10%. I know that Exxon is one of your picks today, but let me ask you about those other two, Intel and J&J. Are you still comfortable holding them? Would you buy more?
Absolutely.
Why?
In both cases, they're in businesses we need. They're understandable businesses. Intel, you can't run your computers without them. Johnson & Johnson, we wouldn't have the life expectancies we have without their products. They're strong businesses financially. They have little debt. They're going to be around a long time.
What about Exxon, though, Randall? I mean, if this oil cycle is going to be longer than we've seen previous cycles, and we're not yet at the bottom in crude, how is that going to impact Exxon's bottom line? Would you buy more here?
Oh, absolutely. Well, we will buy more. In fact, we're going to do something that I hope you see as courageous. We would double up and also, oh yes, move money into Chevron also. Now, we've been owning it in our larger portfolios, but in a smaller portfolio like we're looking at today, we will go in. These companies are not going out of business. You know, people are assuming that oil prices are going to fall. I'm hearing below 20 like it's gospel. But many investors are assuming that these oil prices are going to fall to $1 or $2 a barrel. That's not going to happen.
All right, let's talk about Chevron, which we just pointed out is now in bear market territory, and how off 40% from its high. I assume you like, among other things, a very juicy dividend that just got a little juicier today.
We absolutely do. You're talking about a dividend of over, what, 5.5%. So this is more than twice that of the 10-year Treasury.
Would they ever cut it? Would they ever cut the dividend?
Oh, it's always possible. If the earnings fall for a sustained period below the dividend rate, then they would cut it. But they could afford to cut it in half, and it's still more than the 10-year Treasury yield. And the company would be keeping more money and becoming richer.
So, Randall, what about the overall market? That was one of the big debates today, is how much lower the S&P needs to go, will go, or is it bottoming out? What do you think?
Yes. Well, I don't think it's bottoming out as far as looking at a bull bear market cycle. But in the long term, you know, we expect stock prices to go up as these companies are profitable and add to their net worth or their book value. But the fact is, the price to book ratio, which is one we like to look at, is close to 3 right now. The price 3 times the book value. And I would be more comfortable seeing that closer, under 2.5, getting closer to 2. But you see, that's not expecting the markets to fall by half.
All right, let's go to your third choice very quickly, Randall, and that is Intel.
Yes. That was on the list last time. Again, you can't run your computers without them. This is a company, again, very little debt. They have constantly proven the naysayers wrong, who think that their business model is broken. They keep finding ways to remain relevant, and there's no doubt in my mind they will continue to. They also have tons of money to keep up their research efforts.
Randall, stay cool down there in Washington, my hometown.
Thank you. You too.
All right, Randall Ely with the Edgar Lomax Company.
Deere's profits tumbled, and that's where we begin tonight's market focus. The world's largest seller of tractors and combines reported a slump in demand for new tractors as crop prices fell. The company trimmed its profit and sales forecast for the year despite topping analysts' expectations in the most recent quarter. Shares of Deere down over 8% to $83.29. Shoe and apparel retailer Foot Locker beating analysts' earnings and revenue estimates for the 8th quarter in a row. Same-store sales grew nearly 10% for the retailer, which operates more than 3,400 stores in 23 countries. Shares rose early in the trading day but fell along with the broader market to finish at $69.02.
And speaking of shoes, the board of shoemaker Skechers approved a 3-for-1 stock split. The CEO calls the decision an indication of confidence in his business model. If approved by a shareholder vote in September, both Class A and Class B shares would be split. The news sent the stock up initially, but ended the day down more than 4% at 140.63. The global transport giant FedEx said it will formally start its plan to acquire the Dutch firm TNT Express next week. The company expects its $4.8 billion offer to clear any regulatory hurdles and be approved. FedEx ending the day down nearly 3% today to 156.03. Well, demand for IPOs had been very hot, with investors gobbling up shares of new publicly traded companies. But that seems to be changing. Many of those offerings are now trading below their IPO prices, and with the continued market sell-off, the pipeline of new shares may be cooling as well. Dominic Chu has the story.
U.S. stocks are capping off one of the most volatile weeks in recent memory, and some traders are saying the losses may have been hinted at by performance of recent initial public offerings, or IPOs. Just look at stocks like Chinese e-commerce giant Alibaba and social media company Twitter. Both were hot IPOs at one point, but both are now trading right around their original debut price. Renaissance Capital is a firm that manages funds tied to the IPO market, and according to their data, many of these stocks had been outperforming the broader market at least to start the year.
The returns on the IPOs that happened at the end of 13 and into 14 were very strong. So that encouraged investors to become more confident and participate and to chase those returns. So it's really about the returns, and that keeps the action going with IPOs.
But over the last month or so, the performance of recent IPOs has started to falter and are now underperforming. That could have a big effect on how the market views these types of new stock issues in the coming months. It may also discourage some companies from trying to go public if markets continue to be volatile.
Almost half of the IPOs done so far this year are trading below their IPO price. So we expect to see a ratcheting down of the valuations of the IPOs that are going to come out, and in fact maybe a slowdown in some that may not be able to get done if we continue to have this very weak overall market scenario.
But not all companies may be as negatively impacted. Investors are watching closely for a number of high-profile companies in particular to see if they test the IPO waters anytime soon.
We can't forget that so many are waiting for Uber and Airbnb. It'll be interesting how the market, if they come out this year, I think it may be unlikely at this point, but how the market will treat these companies when the internet companies have been so poorly treated in this existing trading environment.
Volatility in the broader market will play a big role in whether private companies attempt to go public, regardless of their popularity or their market valuation. For Nightly Business Report, I'm Dominic Chu.
And coming up, rapid repairs, why the state with the highest percentage of bad bridges is looking to the private sector for help. It's the final part of our week-long series, The Big Fix, and it's straight ahead.
Well, the economy will be in focus next week. Here's a look at what to watch. A number of housing reports are due out, including new and pending home sales. We'll find out more about economic growth with the second read on second quarter GDP, and we will have reports, you bet we will, from Jackson Hole, Wyoming, where the world's top central bankers will meet at the Kansas City Fed's annual symposium. They know how to pick a nice place. That's what to watch next week.
The used car market is hot, but not because it's cheap. Edmunds.com says the average price for a used car hit a record high of $18,800 in the second quarter. That's an increase of 7.5% year over year. The same factors behind this year's rapidly rising new car sales. Better economic outlook, low unemployment, and low interest rates are also driving used car sales.
The nation's bridges are on shaky ground. The government says 10% of them are structurally deficient. Doesn't mean they're about to collapse, but they do need to be repaired. The cost to fix them estimated to be almost $21 billion a year for the next 13 years. The problem is particularly bad in Pennsylvania, which has the most deficient bridges of any state. And as Mary Thompson tells us, in the final installment of our series, The Big Fix, Pennsylvania is looking to the private sector for a solution.
Pennsylvania's got a problem, or 4,200 of them in the form of structurally deficient bridges.
While that number is the lowest it's ever been, it's still a lot of bridges. So we need to really work hard and aggressively to reduce that number even further.
So the state Secretary of Transportation, Leslie Richards, says it's spending almost $1 billion on a public-private partnership to repair 558 bridges in 3 years.
Normally, it would take about a dozen years to get to this many bridges.
Daniel Galvin works for the firm running the bridge project, the Walsh Group. Critical to meeting the deadline, repairing a single-span bridge like this one in 10 weeks rather than the typical 6 months.
We'll come in, remove the old one, tear out the abutments, pile driving, put in new abutments, and then put the deck in place, repave it, and it's back open for business.
Helping to save time and money, using uniform methods to repair and rebuild the bridges, and buying materials in bulk.
Here in Cressona, Pennsylvania, Northeast Prestressed Products will be making almost 2,300 of beams like these.
Those beams slated for the targeted bridges, which in an unusual twist, will be maintained by the Walsh Group for a much longer than normal 25 years.
So we've got an investment in this project to make sure that the quality is there and that it lasts the 100 years that each one of these bridges are supposed to stand up.
For Nightly Business Report, I'm Mary Thompson in Cressona, Pennsylvania.
To read more about what Pennsylvania is doing to fix its bridges, head to our website, nbr.com.
And before we go, here's another look at today's sell-off on Wall Street. The blue chip Dow index tumbled 530 points to 16,459 on very heavy volume. The Nasdaq shed 171 points. The S&P 500 lost 64. And for the week, all the major indices were off more than 5%. Next week's going to be a tricky one, I think.
Oh, yeah.
That'll do it for Nightly Business Report for tonight. I'm Sue Herrera. Thanks for joining us.
And thanks from me as well. I'm Tyler Matheson. Have a great weekend, everybody. Inject plenty of liquidity. Yes. We'll see you on Monday.